Welcome to Compasscope. Our research platform covers over 1,100 public companies. Each week, we share one of our active research files here in dialogue format.
Usually a bank really announces itself, like marble columns, heavy vault doors, maybe a long row of teller windows.
Yeah, absolutely.
But-
You walk in and you immediately know exactly what kind of institution you're dealing with.
Right, it commands this physical presence that just tells you, hey, your money's being held inside a fortress.
Very true.
But if you look at the landscape of Japanese fintech today, that architecture is just completely invisible.
The vault is gone.
Exactly, the tellers are gone. And the bank is somehow just hiding in plain sight. I mean, it's living right inside the app you just used to buy a bottle of green tea at the convenience store.
It represents a really fundamental shift in how financial infrastructure is actually deployed today. We're moving away from what you might call destination banks.
Destination banking, right?
Right, where you have to actively choose to go to a financial institution. And we're moving toward embedded finance, where the institution simply, wraps itself around your daily habits.
Okay, let's unpack this because we are looking at a brand new, incredibly comprehensive research report from Compasscope today. And it's focusing on PayPay Corp, trading under the stock symbol PAYP.
It is a massive report.
It really is. And if you are evaluating this company's long-term financial trajectory, you have to realize this report is not just profiling some payment app.
No, not at all.
It reads like a literal blueprint for a digital land grab in Japan's evolving financial landscape. So our mission for this deep dive is to figure out how a simple QR code app is aggressively transforming into an all-encompassing financial ecosystem.
And to understand that trajectory, we really have to look at how Compasscope defines their core identity. The report calls PAYP a payments-led, data-driven fintech platform.
Payments-led.
Yeah, that phrasing is highly intentional. They are using daily, low-friction transactions as a structural funnel. So buying that green tea is essentially a loss leader.
Or like a break-even event, right?
Exactly. It's an event that serves as a user acquisition strategy for their much more lucrative, complex financial products.
And the sheer scale of that funnel is just staggering. I mean, we are talking about over 70 million users.
It's huge.
And they are accepted at over 10 million partner stores.
What?
That is their foundational pillar, right? The payments and merchant services.
Yes, the QR and code-based mobile wallet, you basically see it practically every register in Japan right now.
But then they take that and stack 4 additional pillars right on top of it. You have credit and card, which includes the PayPay card in their lending business.
Right.
Then you have actual banking and deposit services through PayPay Bank. 4th is investment and securities, offering in-app wealth management.
And finally, that ecosystem and data pillar, that's the one integrating them with SoftBank, Line, Yahoo, and their partnership with SMBC and the Olive platform.
When you look at all 5 of those pillars collectively, the strategy becomes incredibly clear, doesn't it?
It really does.
Yeah.
The payment network is the acquisition engine, and the other 4 pillars, well, those are the monetization engines.
I was trying to visualize how this cross-selling engine actually functions in practice, and a lot of people compare it to a digital Trojan horse.
A Trojan horse, yeah, I've heard that.
But that implies they are sneaking something malicious onto your phone. I think it operates more like digital gravity.
Gravity, oh, I like that.
Yeah, like the QR payment is just this small moon that pulls you into their orbit because you want a quick checkout and maybe a few loyalty points.
Right, the friction is low.
Exactly. But once you are scanning that app 4 times a day, the friction to open a savings account drops to literally 0. It's just a single tap in the same interface.
They aren't hiding the bank at all. They are just making the gravitational pull of convenience so strong that you basically can't escape the ecosystem.
So is that accurate? Is that how you look at it?
I'd completely validate that analogy. That concept of zero friction is their entire strategic foundation. And the fuel generating that gravitational pull is, without a doubt, the data.
The transaction data.
Yes. The information collected from those daily coffee, lunch, and transit purchases is the underlying asset. They aren't just logging what you buy.
Right.
They are actively utilizing that granular day-to-day behavioral data to inform real-time risk modeling and credit underwriting.
Let's drill down into that mechanism because this is crucial if you are, say, analyzing their valuation. How exactly does buying a convenience store snack translate into an investment portfolio allocation or a loan approval?
It's a great question.
Because on the surface, knowing my snack preferences doesn't exactly seem like it equates to creditworthiness.
It really comes down to predictability and cash flow visibility.
Yeah.
A legacy bank sees your financial life in these delayed monthly snapshots, right?
Right, like an end-of-month statement.
Exactly. So they see a salary deposit, a mortgage payment, a credit card balance. It is a very low-resolution picture. PAYP, on the other hand, is getting a high-resolution, real-time feed of your disposable income.
And your behavioral consistency, I imagine.
Precisely. If someone normally buys premium items and suddenly shifts to extreme discount purchasing patterns, PAP's algorithm flags a potential cash flow squeeze weeks before that user ever misses a formal loan payment.
Oh, wow. So they see the trouble coming before the bank does?
Right. They are underwriting based on real-time cash flow velocity rather than just relying on a historical, backward-looking credit score.
That real-time visibility is a formidable advantage. But because they are pushing into banking, credit, and investments all at once, they are stepping on the toes of some massive incumbents.
Oh, absolutely.
When you try to replace a traditional bank, you suddenly wake up fighting legacy financial institutions and tech conglomerates at the exact same time. How does a QR code app defend its ecosystem against a behemoth like, say, the Rakuten ecosystem?
The contrast between PAYP and Rakuten is one of the most compelling parts of the Compascope analysis, honestly.
Because Rakuten has e-commerce, content, telecom, and financial services deeply locked in.
Right. Rakuten's structural advantage is its breadth and its e-commerce dominance. If you are a heavy user of Rakuten Ishiba, the switching costs are notoriously high because of the compounding value of Rakuten points.
Yeah, nobody wants to walk away from their points.
Exactly. But PAYP recognized they couldn't beat Rakuten online initially, so they dominated the offline world, particularly the small to medium merchant space.
So Rakuten owns the digital shopping cart.
And PAYP owns the physical cash register at your local noodle shop or dry cleaner.
They bypass the digital battlefield to win the streets. I love that. And what about the telecom wallets? You have OPA from KDDI and d-Barai from Docomo.
Right, the carriers.
Those companies already possess millions of mobile subscribers and existing billing relationships.
Telecom wallets certainly have a captive audience, that's true.
Yeah.
And they can easily tie payments to phone bills or handset upgrade campaigns.
Which seems like a huge advantage.
It is, however, the Compascope research points out a major structural limitation. Telecom wallets are inherently restricted by their carrier's ecosystem. PAYP, operating as a carrier-agnostic open platform, basically bypassed those artificial borders. That neutrality allowed its network effects to compound at a vastly accelerated rate compared to a wallet locked inside a single telecom provider.
Okay, but then you have the traditional giants, legacy banks like SMBC and MUFG, alongside the major card issuers. I mean, they have immense capital reserves,
Huge reserves.
established regulatory frameworks, and decades of institutional trust.
Those legacy assets form an incredibly powerful defensive moat. Traditional banks have the deep capital required to weather severe macroeconomic storms.
Right.
But PAYP controls the digital front end. They own the daily touchpoint with the consumer. We are seeing a structural shift where traditional banks are increasingly relegated to being back-end utility pipes.
Just moving the money around in the dark.
Exactly. While digital platforms like PAYP capture the front-end interface and consequently the consumer relationship and the highest margin opportunities.
So, what does this all mean for user loyalty? If we are evaluating the defensibility of that front-end interface, we have to look at a glaring vulnerability, right?
Definitely.
The structural weakness here is multi-homing. Because Japan very wisely created unified QR code standards, the switching costs for both the consumer and the merchant are virtually non-existent.
That's a huge factor.
If I can scan any QR code, aren't users just going to use whatever app gives them the best cash back on any given Tuesday? If PAYP drops their cashback rates by 0.5%, users don't have to learn a new interface.
Right. They just open Rakuten Pay or d-Barai.
They simply tap a different icon on their home screen. So where is the actual enduring loyalty?
What's fascinating here is that you've identified the core existential threat to their current model. In a zero switching cost environment, loyalty is entirely transactional.
They've rented.
Yes, it is rented through continuous promotions.
Right.
This lack of exclusivity means if PAYP stops subsidizing transactions today, their market share could evaporate overnight.
To outrun that multi-homing vulnerability, they clearly can't just rely on scanning QR codes forever.
No, they can't.
They need a structural mechanism to lock people in permanently, to move them from rented loyalty to embedded loyalty. Which brings us to their growth strategy.
Right. The financial blueprint compass scope outlines for the next decade. The grand objective here is a comprehensive financial pivot.
Okay, what does that look like?
Currently, basic payment processing drives the engine and acquires the users. Moving forward, the goal is to structurally shift the revenue base so that roughly 50% of total income is derived from high-margin financial services.
Meaning things other than just taking a cut of a coffee purchase?
Exactly. Relying heavily on the interest from consumer loans, credit card revolving balances, and the fees from wealth management products.
They also have substantial macro tailwinds pushing this strategy forward, don't they? The report notes that Japan's cashless ratio is projected to jump from approximately 46% in 2025 up to roughly 70% by 2035.
That is an immense expansion of the total addressable market. It is a demographic and technological tide lifting all digital platforms.
A rising tide lifts all boats.
Right. And PAYP plans to capture a disproportionate share of that new transaction volume domestically while simultaneously executing a really calculated international expansion.
I read about that. Rather than trying to build a merchant network from scratch abroad, which is incredibly capital intensive, they are partnering with Visa in the U.S.
Yes, it's a capital-light approach. It allows them to offer cross-border utility to their Japanese users traveling overseas without bearing the heavy infrastructure costs.
Here's where it gets really interesting. The profitability targets outlined in this report are just incredibly aggressive.
Very aggressive.
They are aiming to drive their company-wide adjusted EBITDA margin from around 29% in 2025 up to roughly 44% by 2035.
A 15-point margin jump.
Delivering a 15-point margin jump is an operational Herculean task. How do they possibly pull that off without alienating their user base who are so used to heavy promotions?
That margin expansion relies entirely on the maturation of their network effects. When a platform reaches 70 million users and 10 million merchants, the network becomes self-sustaining.
Because everyone is on it.
Right. The merchant has to accept it because every consumer uses it, and the consumer uses it because every merchant accepts it.
Ah, I see.
Once that critical mass is achieved, PAYP intends to systematically taper off the expensive customer acquisition subsidies.
So they swap out the stickiness of a point campaign for the stickiness of having your deposits and loans tied up in the app.
Exactly, the mechanism. A digital coupon is trivial to walk away from. But transferring your active stock portfolio, unwinding a consumer loan, and migrating your primary checking account to a new provider, that introduces substantial friction.
Nobody wants to do all that paperwork.
Right. That operational friction is precisely what protects those 44% margins.
Hitting a 44% margin target on a pristine Excel spreadsheet sounds fantastic. But doing it in the real world, relying on unproven credit models, introduces an entirely different class of structural vulnerability. Let's examine the execution risks.
We have to, because the operational landmines compass scope outlines are severe.
Yeah.
The most prominent landmine is undeniably credit risk. PAYP is rapidly scaling a loan book, extending credit to both consumers and their small to medium merchant partners.
And as we discussed earlier, they are relying heavily on their proprietary transaction data for underwriting those loans.
Correct.
See, I really want to challenge the core premise of this data advantage again, specifically in a distressed environment.
Go for it.
Knowing a user's real-time cash flow velocity is brilliant during an economic expansion, but is knowing that I buy a lot of convenience store snacks actually a reliable predictor that I'll pay back a $5,000 personal loan in the middle of a severe recession?
If we connect this to the bigger picture, your skepticism mirrors the exact concerns held by regulatory bodies and credit rating agencies.
Oh, really?
Yes. Traditional banking institutions possess credit models that have been brutally stress-tested through multiple severe macroeconomic shocks. Legacy banks know precisely how their specific portfolios behave when unemployment spikes to 8%.
Or when inflation erodes purchasing power, right?
Exactly. Whereas PYP's transaction-based underwriting has only really existed in a relatively stable, low-interest rate environment.
So it's basically an untested engine in bad weather.
It is fundamentally an unproven hypothesis under severe macroeconomic duress. If their algorithmic models misprice credit risk during a downturn, they will experience elevated loss rates that could rapidly erode their capital base.
Which would completely derail those 44% margin targets.
Instantly.
And beyond the credit models, there's the sheer strategic complexity of their operational build-out. They are attempting to scale a licensed bank, a securities brokerage, and a credit card issuer simultaneously.
All while managing the largest core payment network in the country.
Yeah, the operational burden of managing three distinct, highly regulated financial entities under one corporate umbrella is immense.
It exposes them to compounding regulatory risks. They are subject to banking capital requirements, securities compliance laws, consumer protection statutes, and increasingly strict data privacy regulations.
Operating across multiple highly regulated sectors is a minefield. If the Japanese government decides to intervene, say, by imposing strict caps on merchant interchange fees, their core monetization levers are instantly compromised.
Or if they legislate restrictions on how transactional data can be utilized for credit underwriting, that's another huge hit. The compliance frameworks required to navigate those sectors alone demand continuous, heavy capital investment.
So a single regulatory misstep could result in crippling fines.
Fines or even structural limitations on their growth strategy.
Given these massive risks and ambitious long-term goals, we need to look at tangible evidence of how the company is actually performing right now against these challenges.
Thankfully, Compasscope provides some crucial recent business updates that serve as a proving ground for this grand strategy. The most significant update regarding their current financial health is a major profitability milestone.
Okay, what happened?
The core payments business officially became operating income positive in 2024.
Wow, that signals a major inflection point. It proves their core unit economics are finally maturing beyond the subsidized growth phase.
Yes, exactly.
They're no longer just burning venture capital to buy market share. The foundational payment engine is demonstrating actual self-sustainability.
Furthermore, their take rate, which is the percentage they capture from each transaction, is exhibiting a gradual upward trajectory. The report models an expansion from 1.17% in 2024 to a target of 1.2% by 2034.
I mean, 3 basis points sounds microscopic in isolation.
It does, but applied across their astronomical transaction volume, it translates to a massive infusion of high-margin revenue. They are achieving this incremental expansion primarily by shifting their focus toward online merchants and higher-margin transaction types.
But looking ahead, the most critical operational event on the horizon is the massive integration slated to begin in 2026.
Yes, the big one.
They are undertaking the incredibly complex consolidation of the Line, Yahoo, and PayPay ecosystems. And if you are tracking IT infrastructure projects, consolidating user identities, merging distinct loyalty point schemes, and unifying the user experience across 3 sprawling digital platforms, that just sounds like an operational nightmare.
It's extremely difficult.
And they are attempting this at the exact same time they're trying to aggressively scale a highly regulated banking arm.
The 2026 integration is the definition of a strategic double-edged sword. If they execute the technical merger seamlessly, the resulting synergies are extraordinary.
Because of the cross-selling.
Right. Their customer acquisition costs for new financial products will plummet to near absolute zero because they can fluidly cross-pollinate hundreds of millions of existing accounts across the Line messaging app, the Yahoo web portal, and the PayPay wallet.
But the downside risk is equally extreme. If they botch the database migrations, or if the merged loyalty system fails to properly credit users, the resulting service disruptions could cause immense friction.
And referring back to the multi-homing vulnerability we discussed earlier.
Right. If you frustrate a user today, they don't patiently wait for a software patch. They instantly open Rakuten Pay.
Exactly. The switching cost is too low to survive a botched integration, which is why the execution of this 2026 consolidation will be the ultimate litmus test for management's operational competence.
Drawing all these threads together, Compasscope lays out a specific checklist for tracking PYP's future viability. With these current updates acting as the proving ground, we can distill exactly what metrics matter most moving forward.
Right. If you are monitoring this company, these are the critical keys to watch. First on that list is the delicate balance between market share retention and margin discipline.
Can they successfully maintain that dominant, greater than 60% share of the QR market while simultaneously reducing those expensive promotional subsidies?
Essentially, monitoring the elasticity of their user base when the financial incentives diminish. Will people stay? The second critical metric is credit performance.
Right. Keeping an eye on the loans.
Analysts must closely track the delinquency and default rates across both their consumer lending and merchant advance portfolios, particularly as Japan's macro environment shifts away from negative interest rate policies.
And the third key is the regulatory stance. Any legislative chatter regarding government caps on merchant fees or new frameworks surrounding data privacy and algorithmic underwriting will have immediate consequences for their revenue projections.
This analysis really highlights a fascinating structural tension at the heart of the company.
To summarize that tension, you are basically watching a hyper-growth tech platform deliberately transforming itself into a highly regulated traditional bank. By doing so, they take on the risks of both.
They carry the software risk of complex platform integrations, compounded by the balance sheet risk of loan defaults and capital adequacy requirements.
It requires a flawless high-wire act.
It does. And this raises an important question, Riot. You have to consider the broader macroeconomic environment in Japan. GDP growth, the Bank of Japan's interest rate maneuvers, and long-term wage trends will ultimately dictate whether the consumer spending velocity that PYP fundamentally relies upon will actually hold up.
Because if the Japanese consumer faces a prolonged spending contraction, or if defaults spike on those frictionless app-based loans, the entire growth engine just stalls.
They are attempting to rewrite the fundamental rules of how financial services are originated, distributed, and monetized in Japan. They're proving that the point of sale is no longer the end of a transaction.
It's just the beginning.
Exactly. It's the beginning of a comprehensive financial relationship.
So just to briefly recap our journey today, we've seen how a simple QR code app is trying to become a financial behemoth, seeking 44% EBITDA margins by 2035.
It's an incredible balancing act.
Balancing incredible data advantages against the risks of unproven credit models and fierce competition. And that leaves us with a final, slightly provocative concept to ponder before we wrap up.
Okay, what is it?
If PIP successfully navigates all these operational landmines, if they actually prove over the course of a full economic cycle that your daily transaction data like coffee and grocery purchases is structurally superior to a traditional credit score for underwriting risk, what happens next?
That's a big if, but a fascinating one.
Right. If the friction to open a bank account drops to zero inside an app you already use every day, will we see other non-financial entities with massive data funnels attempt to become banks themselves, like global telecom operators, ride-sharing networks, or massive retail conglomerates?
If behavioral data combined with daily engagement is the new collateral, then any platform with sufficient engagement and data density could, theoretically, transition into a banking entity.
Could the success of this model signal the fundamental end of the traditional banking monopoly? Suddenly, that invisible architecture we talked about at the beginning doesn't just belong to specialized fintechs.
It belongs to anyone who owns your daily digital habits.
Exactly. Thank you for joining us on this deep dive into the CompassScope report on PayPay Corp. Keep digging into the research, keep questioning the numbers behind the narratives, and we will catch you next time.
This content is produced by CompassScope.com. For more than 1,100 public-listed companies, find detailed company research reports, visual mind maps, earnings call analysis, and audio discussions on CompassScope.com.